When you change jobs, you typically get to choose what happens to your retirement savings. In other words, where do you move the money? You have several options and you might not be aware of all of them. So we're going to go over 5 different choices that are available to you as you navigate this change, whether you're changing jobs or retiring. We'll also get into some of the pros and cons of each choice so that you can hopefully pick the one that fits you best. The thing that most people do is move the money to an IRA. That's not necessarily the right choice for everybody. And I have a video that does a deeper dive on the pros and cons, but at a high level, you just get a lot more control when you move the money into an IRA. It's an individual account that you control as opposed to a workplace account that your employer or your former employer controls for you. I think the thing that most people value most is the ability to choose the investments, or at least have somebody else, if you hire an advisor, for example, have them manage the investments in a way they want instead of just using the menu of investments available in the retirement plan. If you have an excellent retirement plan, then that might not be a factor, but in many cases, you can improve things. The other thing is that it is a lot easier to get access to your money. So with a typical IRA, you can maybe go online or make a quick phone call and ask them to transfer money right to your bank account or send you a check. But the process is not quite as easy if you leave the money with your employer. If you do that, then when you fill out a distribution request form or you call them up, they typically need to have that approved by somebody, and it can take a couple of extra days, sometimes longer, or sometimes not if it's a very efficient employer. But getting that money when you want it can be tricky. Before you make the move to an IRA, you want to carefully examine the fees and expenses and different risks that happen to be in each type of account. One of the things that is often available in an employer plan that you can't get in an IRA is a stable value fund that happens to pay a nice rate of interest. It's not always available, but if that's a feature that you have, you want to evaluate if that's something that you want to keep. So it might pay more than a money market fund, for example, in your IRA. And if you happen to be extremely conservative, that's something to look at. And if you do decide to move the money, it's best to do it as a direct rollover to your IRA. In most cases, maybe not in all cases, but what you want to be aware of is if you do cash out and get a check payable directly to you, and yes, they still do write checks, they will typically withhold 20% for federal income taxes. That's mandatory tax withholding, and that might be something that's difficult for you to come up with as you replace those funds in your account. So be aware of that if you decide to do a rollover. Now, just a quick reminder, this is just one short video. I can't possibly cover everything comprehensively, so please check with a professional who is familiar with your situation, with your retirement plan, and with your personal finances, and that way you reduce the chances of any problems. So where exactly should you open an IRA if you decide to go that route? We have a lot of options. One is just to use one of the major brokerage firms, the ones you've probably heard of, that can allow you to invest in mutual funds and ETFs and just build your own portfolio. You can also hire an advisor to do things for you, and they will typically have you open an account at a custodian that they use. You can use robo-advisors if you're so inclined, or you can open an IRA at a bank or credit union. If you do that, you're typically going to be investing in CDs and savings accounts unless they have a separate investment branch where they're going to send it to a different firm that holds the investments, and your representative at the bank or credit union would manage the money for you. You can also move money to your next job's plan. So if you're not retiring, but you're just changing jobs, your next job might have a 401k, for example, and you could roll the money from the old plan into the new one. That can be helpful just if you want to keep things simple, have as few accounts as possible and less to keep an eye on. Plus, if you ever do want to borrow against your 401k balance, not saying that's a good idea necessarily, but you would have a bigger balance that you could borrow from. But once again, before you make that change, you do want to carefully scrutinize the fees and the investment options and other features of the plan, and be aware that you might not be able to get your money back out of the plan if you move it in there. Sometimes your rollover balance is available for you to take at any time, but that's not always the case, so just double check. If you decide to cash out, you can just send the funds directly to a checking or savings account. Now, be aware that this often has some tax consequences. I mentioned the 20% withholding, so check on that before you do it. And you may owe income taxes plus additional penalty taxes if you're under a certain age. So just be very careful and make sure that's the right choice. If you want, and you're actually going to spend some money soon, you could send that money to an IRA first and then take out the amount you need, not necessarily cashing out the whole thing. Or your former employer might allow for a split distribution. And in that case, you would ask them to send you a portion of the cash and then they roll the remainder over to an IRA, and that way you minimize the tax consequences. Next, you've got annuities, and these are products from insurance companies that can provide certain guarantees. And the simplest, most straightforward annuity is something that pays you income for the rest of your life. So you might want to get some guarantees, and that way you don't worry about what the markets do. However, there's no such thing as a free lunch, so you want to be aware of some of the trade-offs of annuities. This is not a long enough video to give this a full treatment in terms of the pros and cons, but I do have other videos out there for that. Just be aware that you may lose some flexibility. You may be paying fees and expenses, and you can't really tell what you're paying in most cases. So be sure to check with a number of different insurers or with a really trusted financial professional if you decide to go this route. The next option is to just leave the money with your former employer, and that might be something you do if you just don't know what to do yet, or if you really like that retirement plan. If they've got an excellent low-cost plan with good investments, that might be something worth considering. So you might need to have at least $5,000 in the plan to do that. In some cases, if you have less, they can eventually force you out of the plan. So you want to pay attention if that's the case for you. And again, just be aware that when you leave it with an old employer, you kind of want to pay attention because you're not controlling the investment options or even the vendors they use with the retirement plan. So if they decide to move it, that's something you're going to want to keep up with. Did they move it to a better place or a worse place? That sort of thing. So now you know at least 5 options you can work with. If you found this helpful, please leave a quick thumbs up and take care.